Hello, this is Ted Lee Fisher from Phuket. It's February 25th, 2018. It's been 1 week since we met in Milan, and I would like to go over some of the things that I presented that day that I felt I wasn't kind enough to the translators to give them time to get the entire concept out to you in Italian. So today I'm going to try to go over everything again that I thought was important, and hopefully I will be able to pace myself so that the translators will be able to get the entire concepts uh, to you in your native language. The first thing that I want to talk about is the golden mean, uh, which the example I'm going to give you is broken down to the golden ratio. And in any segment, no matter what its length, there is one place where it can be cut, where that cut gives you a shorter and a longer segment. What is special about the place of this cut is that when you take the length of the short segment and multiply it times 1.618, you get the length of the longer segment. And if you take the length of the longer segment times 1.618, you get the entire length of the segment. So the relationship of the shorter to the longer can be said this way, and I hope it translates well in English, but it creates a very nice offset to the egalitarian concepts in Western philosophy. But the lesser is to the greater as the greater is to the whole. That is, the lesser is to the greater as the greater is to the whole. So there's a balanced relationship, a mathematical relationship, in which the lesser segment times 1.618 is equal to the length of the greater segment. And the greater segment times 1.618 is equal to the entire segment. Now, this is in many ways a very magical ratio, but it comes from the very structure of nature. When you look at the Milky Way, you see a logarithmic spiral. When you look at a nautilus shell that you find on the beach, you see a logarithmic spiral. In many of the natural structures of the universe, there's a logarithmic spiral. And when you take the diameter of the logarithmic spiral, you find this mathematical relationship of the golden ratio. This was applied in the construction of the pyramids in Egypt, and applied many different ways. And I'm going to try to show you how it can be applied to understanding market structure, market direction, and market behavior. When you apply Fibonacci ratios, which the golden ratio is derived from, you can make different forecasts based upon the historical movement of a particular price. If you go from 0 to the top of 1, and then you have a retracement that comes back to test the low of 1, the average, or the not the average, but the expected extreme pullback or retracement would be 62%, 0.618 to be exact. If you have an advance, a pullback of 62%, you take the length of the wave 1, multiply it times 1.618, add it on to wave 2, and you get the approximate target objective for the exhaustion of upside energy at wave 3. Then you have a second pullback. If the first one was 0.618 or 62%, then you would expect the second pullback to be 38%, 0.382% to be exact. When you cut the golden ratio, you get 0.618 and 0.382. This example has rounded them off to 62% and 38%. Then you take again the length of wave 1 times 1.618, and you get the target where you would expect the upside energy to exhaust itself, where it's marked number 5 on this chart. Another way that it might be is from the low 1, 2, 3, the length of the low 0 to the top of 3 times 1.618 would give you an extreme extension to the upside. In a bear market, the converse would be true. The first decline, 62% retracement, 1.618 advance, 38% retracement, 1.618 advance. This nothing absolute in the universe. We live in a relative universe. You need to understand that there's nothing absolute, but it's the behavior at or around a price that comes into these calculations. And more times than not, you're going to find some coherence to the golden ratio and Fibonacci sequence in the price behavior of a given stock or commodity. I'm going to pause for a moment now. Okay. Again, this is Ted Lee Fisher from Phuket. It's February 25th, 2018. It's been 1 week since we met, and I'm trying to review some of the things that I thought maybe I didn't give the translators a full opportunity to get their translation out, so for you to get the concept. So I'm going to go ahead. Now, this is the subject of chart perspective. In the presentation, the first thing I mentioned, showed you, was a year chart of the Chinese yuan, better known as the renminbi. It's my hand-kept chart that I've kept over the years. Every dot, every bar is 1 year. So this is 1994 devaluation. You can see that there's early trading in the yuan, a big devaluation. Then there was a peg, and then the peg was broken, and the yuan started to appreciate over this period of time. But please note that this movement here over a substantial amount of time only comes back to the big breakout of the devaluation of 1994. So it's really just a simple retracement of the entire devaluating, losing value of the renminbi to the US dollar that took place before 1994. My underlying thesis, let me go back to the year chart for a moment. My underlying thesis is that we have a segment that is the first major advance in the US dollar versus the renminbi. So as the price rises, the value of the renminbi to the US dollar is falling. And when we take this length and add it onto this low, we get an objective of 13 and a 1.618 objective of 17. After my presentation of Fibonacci sequence, it's easy for you to understand why I think the renminbi can go to 17. 0, 1, 2, 3. This is a more traditional bar chart. It's a weekly chart. Every bar is a week. It begins in 2014 when the appreciation or corrective period in the renminbi that I showed you on the yearly chart terminated, and we began a new uptrend in the value strengthening US dollar versus the renminbi. You can see by the yellow line here where we take the first high, the secondary high, to create a rising trend line. We bring a parallel line down and we create a channel, which is this yellow line channel. The market has a very nice trend from 2014 to the beginning of 2017, and it's contained within the channel. And Ray Merriman had forecast that the US dollar would form a cyclic high, a primary cyclic high, in January of 2017, and the dollar index and the US dollar renminbi formed a high in that window of time. So from a cyclic standpoint, we have to give credibility to this high as being significant, and a reversal of this as generated from cyclic forces of the dollar itself. So what we have is a correction in the uptrend of the US dollar renminbi, I believe. We come down, we hold the channel, we bounce, but then we break through as a natural process of the corrective pattern. We begin to form a down channel, which is formed by this low and the secondary low, and run a parallel line. And so far we're contained within it. So far this low here has only come back to the real where the acceleration to the upside took place in the dollar renminbi. So in many ways, as of today, the decline in the dollar renminbi is consistent with the idea of it having been, or it being in, a correction to the rising US dollar value to the renminbi. I would also point out that it's contained within this trend line, and more importantly, the thesis that I have that the renminbi can go to 13 or 17 in a process of devaluation would be negated if we go below this low that took place in 2014. So as a trader, as an analyst, as a market operator, it's always it's best if you know where you're wrong. And while I have a very, very strong view of the dollar renminbi going to 17, I would be forced to abandon that view and re-evaluate the entire structural pattern if this price decline continues to go below the low of 2014. This is an intraday where every bar is 1142 minutes of the dollar renminbi. You can see that the decline marked on the other chart is contained by the channel. What the salient point I want to bring your attention to is that here's a low that found some reversing energy, and here's a low that came down and made a higher low and found some reversing energy. And when I go to the U.S. dollar chart, I'm going to bring your attention to the U.S. dollar pattern at this coincident with this time frame, and you'll see that it's not consistent. Again, I want to point out that here's a low that occurred in early February, reversing energy, retested the low, higher low, reversing energy. Now I'm going to go to the US dollar, the US dollar index, which is a basket of currencies. This monthly chart only goes back to 1992, but you can see that from 2001 to 2011, we had a significant decline in the value of the currency of the US dollar to almost virtually every currency. This took place you could say for many reasons, but I really don't want to get in a philosophical or econometric debate about it, but the chart itself speaks for itself. Again, from 130 to 80 to below 80, that's a very significant decline on a percentage basis. If the index is 0, it's from the 2011 low. I would point out that we've had an advance in the US dollar, but if you look at the magnitude of this decline and the amount that we've retraced, you'll see that it's barely, it's not even 50% of the previous decline from 2000 to 2011. So this high, again, Ray Merriman had forecast as the primary cycle high in the dollar, and that if this is a natural, if this is in fact a primary cycle high, and we follow the general rules of a primary cycle, this decline is in early stages, and that it should be minimum 3 to 5 years and generally 5 to 7 years. And that, if that's the case, then you had this long decline, this weak recovery, and a new decline. And certainly if it collapses below the 2011 low, the weakness of the dollar would let's just take this length and add it onto here, and you're going to get something that's remarkable to the downside, and certainly a collapsing value of the US dollar in that context would easily explain the Great Reset and the stress on the financial system and the relative value foreign exchange system that we think would be associated with the Great Reset. Now I've brought up a weekly chart of the US dollar index. It's virtually the same picture. It's a little easier to see. But I'm going to put forward an alternative idea to classic cyclic and technical analysis. The general idea is that if we made a cyclic high in January 2017, then the most efficacious way to explain the Great Reset is a collapse of the U.S. dollar, and that the collapse of the U.S. dollar would take place over the next 3 to 5 years as the cyclic forces lead to a primary cycle low at the end of the decline. What I have trouble with is that, first of all, since the inception of the Federal Reserve Bank in the United States in 1913, the U.S. dollar has lost 90% of its purchasing power over the course of their management of the credit and money in the country. And more importantly, since the default on the U.S. dollar in 1972-74, in which caused the creation of a relative value fiat currency foreign exchange system, which we are now under, the regime under which we now operate, the dollar has lost value over all this time. And note also that the U.S. dollar lost significant value 2001 to 2011, and from 2001 to 2007 or 8, certainly the global markets found great expansion, great comfort, and great success. So I think that the markets have been comfortable and have adapted to a declining U.S. dollar over time. And even though the magnitude of the decline would be extremely significant if we take the length of the high from 2001 to the low of 2011, and either take the length or take an expansion of that length to the downside, that we're talking about a massive decline in the value of the currency on a relative basis to the basket that makes it up. So yes, that could be a shock to the system. But the pattern that I want to show you here is that this decline took place, and then we have this movement to the upside. And what I would ask is, what if here is an orthodox high, a correction, an irregular, a correction, an advance to an orthodox high, a correction, an irregular high, a correction, and the market, the dollar index, begins to find reversing energy here and begins to rise. And if it does that, where would it go? And if you go back to the Fibonacci sequence, which I showed you, you take this low, you take this high, the length of that times 1.618 added onto this low would give you a target up here, back up at towards the tops of 2001. And that's exactly what this chart shows. Here's your advance, here's your pullback, here's 1.618 target, right back up at these highs. Now my thesis is that the central banks of the world are short U.S. dollars and short volatility. Many of the natural positions that they have are embedded short U.S. dollars and embedded short volatility. And more importantly, many of the banks between 2009 and 2014, while the Federal Reserve was engaged in quantitative easing, borrowed a significant amount of U.S. dollars to satisfy their capital and funding needs, and those are a huge natural short of the U.S. dollar by these central banks. And once again, a movement from this level to this level could easily be propelled by a short covering rally, and a short covering rally of this magnitude would put significant stress on the balance sheets of many of the central banks of the world. So that's my underlying thesis about how we get to a great reset in a way in which it's unthinkable, and the unthinkable being a rising U.S. dollar. So again, let me go on, and I'll show you a very interesting thing about the U.S. dollar. Here's a daily that in early February we made a low, found reversing energy. We came down and we made a lower low just before the conference. So we have a trending market to the downside. We have a low, we have a correction, we have a decline, we have a low, we have a correction, we have a lower low. This is a bearish sequence: low, lower high, lower low. This is an intraday chart of the dollar index. It shows even more clearly the point I'm making. Here's your orthodox low. Here's your rally, found in reversing energy. And here's a secondary low, the next low, but it's a lower low. And again, we have a bearish sequence all the way down from this high. And more importantly, if we go back to this chart, from the January 2017 high, we have a bearish sequence. This low is lower than that low. That creates a bearish sequence. Here's a higher low, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high, a big decline, lower high, lower low, big decline, lower low, bearish sequence all the way down. Low, correction, lower low, bearish sequence all the way down. I brought this chart because it speaks even clearer. Here's a low, a lower low, and some reversing energy for the US dollar index. Now, if you remember, I asked you to remember about the dollar renminbi. Low, lower low dollar index, low, higher low dollar renminbi. Both found reversing energy on the same day, but one found a higher low, one found a lower low. Divergence at recent lows. In my world, this is known as a bullish divergence, and it's something to be paid attention to. Now, if it only lasts a few days, that's then the market returns to its bearish sequence in both markets. But for now, this is a trading signal, and it's one which has my attention, because the longer that this bullish divergence holds, the more significant it becomes. The more energy the market, reversing energy to the upside, the market finds at higher prices, the more significant this bullish divergence becomes. So we need time for price to unfold to know whether or not how much weight to give this bullish divergence. But here's a lower low, higher low, creating a bullish divergence between the US dollar index and the US dollar renminbi. Now, I want to talk about the euro versus the US dollar, because you're in Italy and you use euro for your transaction currency. It's most important that you understand where we are. If you look at this monthly chart, and we don't have a substantial history of the euro currency because its inception was only a couple of decades ago, whereas the British pound and some of the other currencies, we have hundreds of years to, at least since the inception of the post-American Revolution. We have a history, and we have a relationship of the British pound to other currencies that goes back even further. So that said, we have to be careful about making forecasts about the euro currency because we don't really have the substantial long-term historical base to make those. But what we do have is a pattern that is recognizable. And the high that took place in 2007, which was basically a rise in the currency since its early weakness after its inception. We have a decline to this low, a rally, another decline. We can take this low and this low to form a downtrend line. Then we make a parallel line to connect the next top, and you can see that the market price decline since 2007 is contained by this channel. It's a very orderly decline over time. Big rally, big decline to lower low, another big rally. Now the question is do we have another decline, or is the market poised to go break out to the upside? If you buy into the concept that the US dollar formed a primary cycle high in January of 2017, and that its primary cycle low is 3 to 5 years ahead, then you would naturally make the assumption that this channel is going to be broken to the upside and the euro currency is going to make a significant rise. And if we simply take the length from 2000, 2007, and do some Fibonacci sequence to it, you can see that it's a very significant move, well above 160, to get the euro currency to some significantly higher price, 180 or even higher. If you follow the logic that I put forward, that maybe we don't have a natural primary cycle decline in the US dollar because there's some event or some something that interrupts the cyclic pattern that causes the events that cause the Great Reset, then you would look at it from a different perspective, and you would take the high in 2017, the decline to 2011, take that length, that segment, and expand it to some Fibonacci sequence to take it to a downside target, which would be significantly lower. It would most certainly ultimately involve a throw over or breakdown through out of the channel to the downside. So one way or another, we're going to leave this channel in the next few years, if not few weeks or months. The bulls would argue that it's going to break out to the upside. The shock would be that if it breaks out to the downside. Okay, let's go to a weekly, which is going to give you the same picture, but maybe it's a little clearer. Once again, low, downtrend line to the second low, parallel line across the tops, gives you a down channel. And if we break down, it breaks down significantly. Now, what I want to do with this chart is I want to show you if I'm going to be correct, this is how the market pattern will be labeled upon later on as to explain this entire structural pattern. This is the orthodox low. This is your orthodox natural correction. Here's a 1, 2, 3 decline to a new lower low. This forms what I'm going to call, what I always call, an irregular low. Orthodox low, correction, irregular low. An irregular low generates a huge counter trend rally, which is what we see here, but it doesn't do anything in terms of breaking the bearish sequence. Here's a high, here's a lower high, here's a channel, you're still contained within the channel. If the reversing action that we found in the dollar and the dollar renminbi, and we also found here in the euro currency, feeds on itself, and weakness in the euro currency unfolds, strength in the US dollar unfolds, then we're talking about ultimately we'll get confirmation that this is an irregular low and the orthodox low occurred here, and that the market is still trending to the downside in a very significant bearish sequence. Ultimately will throw over the channel to the downside. By the way, as a trader, a breakout over this high, a breakout of this channel to the upside, that my thesis is loses a lot of validity. So if you are really inclined to be trading the euro currency along my ideas, then you would certainly use this area as your stop and reverse. Once again, I just this is a day chart. I'm going to try to emphasize that here's a very significant decline. It's very impulsive, it's very significant and very fast. We hit this fine reversing energy. We get very strong corrective behavior. So this would be the natural correction here. Here's a decline that doesn't make a lower low. Here's a rally that doesn't really do anything bullish. Here's another decline that doesn't make a lower low over this. And here's a rally to your so what, orthodox low, correction, irregular low. This by the way, I'm sorry, I may have misspoke myself just a minute ago. This low is marginally below this low, so irregular low, corrective leg to the upside, doesn't break out over the channel, finds reversing action and turns down, breaks down, breaks to the channel to the downside. We don't know that that's what's going to happen, but if it happens, the only way to explain this pattern is that this is the orthodox low, this is the natural correction, this is an irregular low, this is a corrective leg as part of the irregular corrective pattern that started from here, A, irregular B, C to the upside, terminate, trend resumes. Okay, Roy asked me to give one trade for 2018 that I thought had merit, one or two trades. The trade I chose is the U.S. corn market. If you look at this weekly chart, it only goes back to 2002, but you can see that very significant high occurred in 2007, 2008. A very significant decline took place very quickly over a 2-year period. Very significant rally again, but it's a lower high. Another decline to a lower low. We are looking at not the cheapest corn prices in the history of the U.S. agricultural market, but certainly very cheap prices for this new millennium. And if I'm right about this, then you take a look at something around $9 as the top of the range. You're below close to $3.50 at the bottom of the range. So $4 to $9 is a $5 a bushel difference. Every dollar for one contract is $5,000. So from this level to this level, this full range, we're talking about $25,000 per contract. And in my opinion, it's not because we have a cyclic pattern where hot and dry weather is due, but it's because we have an El Nino weather development, and El Nino has a tendency to put significant stress on the corn crop at a critical time, and has generated some of the biggest bull moves in history. So I have brought this to the table. Roy has an underlying idea that commodities are turning up on the Kondratiev wave, which I don't dispute, and it sort of fits in. This could be a multi-year trade, but agricultural products in the United States need to be taken on a seasonal basis. So this trade, if initiated, should be considered to be for the growing season of 2018, which means that sometime between the end of June and the end of November would be time to take the trade off. And if we're right about, if Roy's right about the long-term commodity prices rising over time, we'll find a secondary reentry later on. Okay, this daily chart of December 2018 corn shows a low, a significant rally, maybe 45 to 50 cents, a secondary low, and a turn up. So at the very least, I think we're talking about a potential 80-cent move, which is only $4,000 per contract. But again, the difference between here the high that the prices that we're trading at in the current market, and the low that occurred in late 2017, being your stop price, is less than $1,000. So you have a 4-to-1, $4,000 profit, if I'm right, about it going up 80 cents from here, to $1,000 risk. And more importantly, if somehow the trade turns into something more significant and we go to the top of the trading range for the decade, we're talking about $25,000 per contract versus $1,000 risk. I brought this intraday chart to reemphasize the movement to the upside. The behavior changed here. It becomes very impulsive. We have a very sharp pullback that is a retest of the low. Becomes very impulsive again. Very sharp rally, sharp pullback, sharp rally, sharp pullback. Very impulsive to the upside right now. Very, very strong bullish sequence. High, higher low, high, higher low, high, higher low, all the way up, bullish sequence. So that's basically the idea that I have for corn. We have a saying in the United States. I don't know if it's consistent with traders in Europe, but we say it's always best to buy your straw hats in January. In other words, you're going to get your best price. You're going to get the best price for a straw hat. You're going to buy it the cheapest when it's in least demand. In July, August, when it's hot and sunny, straw hats are going to be in big demand, and you're not going to find a discount. Well, it's not January anymore, it's February, but I don't think it's too late to buy corn this year. That's the point. Okay, I brought the gold chart up because it's something that I'm sure is near and dear to everybody's heart that attended the conference in one way or another. I'll just paint a picture for you to start with. We had, as everybody knows, we had a significant uptrend. We had a termination of that uptrend in 2011. We had a very sharp setback on a rally that retraced but doesn't make a higher high, then an even sharper decline in which the market declines over a period of time from 2011 to 2016. Now, there's a Fibonacci sequence that's apparent here, in which you have a decline, a rally, and a second decline. The 1.618 area is here. And again, as I've tried to emphasize, it's not the absolute price. It's the behavior of the price at or around the calculated price of the Fibonacci sequence. Why is this? Because it's a relative universe. There's nothing absolute in the universe. So we have an absolute calculation of 1.618 equals 1203, but it's the behavior at or around. We come down to it, we bounce. We come down to it, we bounce, but it's a weaker bounce. We break down, come back to it, break down even further, but lo and behold, we come back and reverse through it, come back, try to break down and fail through it, but we make a higher low, and we start to build this sequence. Now, this sequence could be considered a coiling pattern, and this entire process could be considered a bottoming pattern. Frankly, we don't have enough. It hasn't moved enough. We don't know enough for that to be the case. But certainly, if this high if we start to trade above this high, which is more or less at $1,400, it's going to turn the market up in many respects. First of all, we're going to think that the length of this added onto this, or some Fibonacci sequence of it, can take the price up into this area here, $1,600 to $1,800 an ounce, which is also where the market had a fast breakdown and did very little trading in this zone here, particularly around 1,600. The second thing is that this red line is going to turn up. And if I can go back and show you just from this little bit of data from 2004 on, when the market starts to move away from the red line, okay, well, it came back to it here, but look how significantly it moved away from it again. And it was when it came back and broke back below it that we knew we were in a long-term corrective pattern, and then it turned down. And if prices go up here, it turns up. Now we're starting to build a pattern to the upside and starting to move away from the red line to the upside. There's no reason in the long run that we can't have something like this to the upside that's even more significant, where you take the length of this and create some Fibonacci sequence to give you an upside target way up here. That's what the gold bulls, particularly the perennial bulls, are always talking about, the $5,000, $10,000, $15,000 an ounce gold. Well, you can get to some of those targets by creating a Fibonacci sequence where you take the length of the low that occurred at the beginning of the millennium and the high that occurred in 2011, and make that a segment and expand it on a Fibonacci sequence to this low. You can certainly get significantly higher prices. The thing that I want to caution you about is that this pattern is unresolved at the moment. And if you notice, there's a tremendous amount of open space all through here. And if rather than breaking above this high at 1,400, we start to break below the low of 2016, it could become very traumatic for the market in many ways. First of all, we're breaking down away from this red line, and we're going to pull the red line down, which means the red line is going to trend down. The trend is down. Prices are falling. Momentum is falling. And there's very little support. And when we take the length of this decline and create some Fibonacci sequence from this high going to the downside, it's easy to start talking about the market returning to its breakout area below $800 an ounce or more. Now, there is some DNA type history for a washout of this low and a very sharp, quick reversal that would mark the primary low of the decline from this high and the beginning of a new bull market. And all I can say is that if you see a break below the December of the 2016 low, and you start to see a very strong reversing action, if you are trained and skilled in doing it, it may be an opportunity to start to build a pyramid position in which you build a long position in gold and silver against that reversal, and you pyramid yourself all the way up to God knows what prices we're going to way above the 2011 high. But you have to be very careful about this, because again, if we break this 2016 low, the structure is vulnerable to the downside, and it's possible that we're going to see a very long sustained decline back to some price that would be unthinkable to the perennial bulls and the general bulls in gold. So I think that we have the 2016 low and the high, and now we have a coiling pattern, and we can try to follow the market out of the pattern if we don't have any other way to do it. And The only caution is that watch the market very closely. If it breaks the 2016 low, and if you see reversing action, you can start to build a pyramid to the upside. Otherwise, we're in for a long, hard, cold winter of discontent in the gold market. Okay, I just brought this daily chart up to really kind of reemphasize the comments that I made about the previous gold chart. Here's a Fibonacci sequence of high in 2011, decline, rally, identify this Fibonacci sequence target to the downside, behavior at or around the price, and here you are. And again, if we break out over these tops, particularly this top here at 1400, I would expect the price of gold to come back up at least to this 1600 to 1800 price area. And it may, once it gets there, it may decide to do more bullish things and give us an opportunity to understand that it's a new leg to the upside. And the caution that I gave you is that if this low is broken, the market becomes extremely vulnerable to the downside, and the length of this subtracted from here becomes a downside target, or some Fibonacci sequence that we would calculate once we see the full structure. Again, this is a daily, and the previous was a weekly, but this red line is a good indicator. You see that the market stayed above it on the significant moves to the upside, and it stayed below it on the significant moves to the downside. Now it's coiling on it. If it leaves it to the upside, it should be in a new trend to the upside. If it leaves it to the downside, it should be in a new trend to the downside. Okay, I'm going to pause for a couple of minutes, let the dogs in the background quiet down, and change to the final presentation. Hello, this is Ted Lee Fisher from Phuket, February 25th, 2018, 1 week after the conference and the presentation I made to you. This is the third segment of that I wanted to follow up and go back and review, because I felt that I didn't give the translators sufficient time to get the salient ideas across to you. And now we're going to talk about the S&P 500. This is a monthly chart of the S&P 500. You can see that very strong trend to the upside. very significant move. And while there's little 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 expectation that this low would ever be violated in the near-term future, there is every reason to believe that the S&P 500 is entitled to have some sort of correction to this uptrend. And if we do a Fibonacci breakdown of the length of this pattern, then 38% back is here, 62% back is here, and 50% back is here. There are other parts of the Fibonacci sequence, 23.6 and 76.4. But for now, I think that really a 34% correction, I'm sorry, a 62. A 38% correction, a 50% correction, or a 62% correction would be extremely significant. A 38% correction would be almost 800 S&P points. That's a very big correction, and it's the most natural area of support. If you notice that there's if I can try simply 1, 2, 3, 4, 5, then this would be wave 4 of a lesser degree. Wave 4 would offer support in itself. It's probably also where the market extended itself in a dramatic fashion and took on just incredible velocity at the upside. So it would be natural for it to come back to this price area, and this being the 0.382 division of the length of the 2009 high to the 2018 2009 low to the 2018 high. This creates two natural supports. One, this price action here from where the rally began, and the 3.382 retracement area here. If that doesn't hold, then 50% and 62% are the natural places where the market would want to go. Two, 3, 4, 5. Back to wave 4 of a lesser degree, 0.382 retracement, natural support around 2000. Now, one thing I will say is that, and I should have said this before, one analyst that has had tremendous success calling the S&P and the Dow Jones over the last 30 years says that the DNA for this market is very similar to the 1950s, and that we should expect a continued bull move, higher highs and higher lows well into the next 5 to 8 years. Another analyst that I have tremendous respect for thinks that the market's vulnerable to a crash, a 1987 crash, or a more significant crash than that, one in which in a matter of hours, days, or weeks, we could take out most of this advance. I don't know how to differentiate or this information at this time. I only know how to operate in the market on a discovery basis, and I think that this bar here is significant. It has my attention, and what the market does with this decline will probably help us understand which one of these analysts is more on track. But for the moment, I'm in a discovery mode with the understanding that this was a significant event in itself. Now this is a weekly chart, shows the same breakdown, same cutting of the segment from the 2009 low to the 2018 high. Here's your 382 retracement bar area. Notice that it's right in the core corrective pattern before we went vertical. And the 618 retracement comes back to where the market really just started to take off. Note that we haven't, it's been since 2011 that we've come back and gone below this red line. We came back close to it in this correction, but then ran away from it again. So it would be significant, maybe if we have a 382 retracement, we would have the market do something like it's done down here, where it breaks below the red line, holds the 382 area more or less, finds support in this corrective pattern, just as this found support at the beginning of this corrective pattern. And then we can build something to the upside again. Now, this was a day chart, and it's of the S&P Cash 500. It shows the decline, and if you take this reversal low of the decline that occurred a couple of weeks ago, in a very fast, hard decline, you have a rally, a decline, and then you give a Fibonacci sequence to it. You see that you found stopping action at or around equality or the same length of this bounce. I would also point out that the Fibonacci 1.618 sequence level is up here, will put you closer to the actual high, and sets up a very, very significant retest of that high. Obviously, if we break over this high, then we're talking about bullish sequence through the whole pattern, and the trend is still totally intact. Please note that this decline came back to the 200-day moving average and found reversing energy as it went was below it, and had a very significant reversal that day. Came back down, didn't even get close to it, and had a secondary rally. The important thing for me is that generally a decline of this magnitude is never all of the decline. It's usually the first break of a break, rally, break pattern, break, rally, break. So if we accept that idea, then we see that from this reversal low, we get a corrective pattern. We don't know if the corrective pattern is finished, but at the presentation, we took this to be the case. And if that's the case, then this being a segment, this being the correction, a Fibonacci sequence would lead the market down to 2185 as a downside target. I would point out that's 600 plus S&P points, not anything that you necessarily want to sit through if you are a buy and hold long, but more importantly, as a trader, not something that you would want to miss. I brought this chart along because it's the 24-hour S&P futures electronic trade chart. You see that the reversal lows are much closer to each other. The overshoot of 100 or equality is a little bit more significant, and it's just part of the natural process of the volatility that goes with the electronic trade. Again, electronic S&P this being the decline, the segment of the decline, this being the retracement. The Fibonacci sequence gives you a downside target similar to what I showed you before. Now, it may be that we need to build a much more complex corrective pattern here, and we may come up close to this high. But I would think that a natural pattern will be ultimately decline, rally, another significant decline that's longer and extended. So that's more or less brings you a full discourse on the charts that I had presented in Milan. And I would like to sometime soon bring you some up-to-date charts to show you how the markets have responded since that day. But for now, I'm going to close, and I want to thank you very much for your kind reception when I was in Milan, and I was very happy to meet so many of you, and so many of you are big thinkers, good thinkers. The questions were important questions, questions that showed an understanding of the situation that I tried to bring to your attention, and I hope that we can all find a good and happy life on the other side of the Great Reset.